Hey everyone, this is Ben Morales and I'm your personal financial coach, and we're going to get right into the video for today. I'm going to be showing you some steps that you can easily take to really speed up how quickly you can pay off a vehicle car loan. That's exactly what we're going to show with this particular scenario. I have a client that I'm working with right now, and his situation is as such. Right now, he has 50 payments still left on a vehicle loan. Okay, so he's at a point in his life where he's just getting into his 50s. So the retirement conversation, the retirement reality is really starting to knock at his door. He doesn't want to be in a huge amount of debt when he gets into his retirement years. So we want to be able to finish paying off the vehicle quickly, and then we want to be able to start attacking the rest of his debt. And let's talk about exactly where his debt is coming from. But first, let's look at his income and his expenses. 5186 is the income, and his expenses is 4375.65. Now I talked about his debt, and what his debt is comprised of is three things. The biggest debt that he has right now is a mortgage, and then we're going to add into that debt as well $14,910, which is for a car loan. And the car loan has a high rate, it's 10.99%. And we can see that the payment is $380.80. In addition to that, he also has a credit card. The credit card is $2,000, so it's not a lot that he owes on the credit card, but it does have a high interest rate, and he's costing him $70 a month in cash flow. So one of the first things that we need to do is we need to change and we need to acquire a debt tool. And a debt tool is actually what we need for him to more speedily and quickly and efficiently do this. So he doesn't have a debt tool right now, and he does have an index universal life policy, but he's just in his first year. And because he's in his first year, he really doesn't have any cash value, so we can't leverage that. So what does that mean now? For us to be able to speed up the process of him paying off this debt, we're going to have to consolidate. We're going to have to consolidate, for starters, his car loan and his credit card. Okay. What we're going to use to consolidate is the personal line of credit. So the first step to do is go and apply for a $20,000 personal line of credit at a interest rate of 9.24. It may be different where you're at, but do your homework, shop around and see exactly the best place for you. I always recommend, when it comes to personal lines of credit, if you can attain one, 10% or less, right? If it's a single digit number, all the more better, but at least 10% or less when it comes to a personal line of credit. And if you have, in this case, a car loan of 10.99 or a credit card at 20, that's pretty much a better deal for you in terms of interest costs over the long term than it would be just having those loans. So that's the first thing we have to do here. We have to apply and obtain a personal line of credit. We're going to do it for 20,000, and then we're going to leverage, combine those two loans, which a total of $16,910. So after doing that, what's going to happen is we are no longer going to have all these separate payments like we do now, right? Income is going to a checking account, and then all the payments are being made throughout the course of the month, which means that we are going to be eliminating two debts, which is going to be the car and the credit card. These two debts are $450.80, right? So let's pause there. If these debts are no longer there, where is this $450.80 going? Well, the simple answer is this now becomes additional cash flow. So instead of having $810.35 as cash flow, his cash flow is actually going to go up, right? But we know when we do velocity banking, when we're doing these strategies like this, whatever happens on the income side is also going to happen on, or whatever happens on the expense side is also going to impact the cash flow side. So since his cash flow has gone up, that means his expenses has gone down, because he no longer has to consider $450.80 as part of this expenses of $43.75. You see how that works? Hopefully that makes sense. So remember, income or expenses are going down, and cash flow as a result is going up. Now we see the new changes to the cash flow. We got our line of credit. We see how it's impacting the cash flow, right? We've consolidated. In a sense, we're making things more efficient in terms of payments. And now we're going to start to apply this strategy. And we have a starting balance of $16,910, right? We know that with this strategy, we start using the personal line of credit as if it was a checking account. No longer will the income stay inside of a checking account and then being waited to be used throughout the course of the month to pay bills. Now, every time he gets paid, he's going to be applying that income as a payment to the personal line of credit. So that means that twice a month, a total of $5,186 of income is going into that personal line of credit. Then also throughout the course of the month, we have to then add back the new expenses, which is $3,924.85. And we're also going to calculate, we're going to give room, and we're going to include the interest for that particular month. Now, when you use a personal line of credit, because interest is calculated on an average daily balance, we have to wait to the end of that particular day so that the bank knows how much to charge you in interest. So I calculated at the highest rate possible, which is 16,910 at an interest rate of 9.24, gives us a average daily cost of $4.28. And all that means is if the interest or if the loan amount stayed at that dollar amount, that would be the most in interest that would be paid for the month. But we know, because throughout the course of the month, income is going to be going and being applied into the line of credit. We know that that's not true, that actually the income or the interest is going to be less. And let's look at just the scenarios, how that looks like as the course of time goes on. So already into the second month, we can see $15,777.25. The income again is going to be going into that line of credit throughout the course of the month, and the expenses also are going to be coming out. The interest is also going to be calculated throughout the course of that month. And we can see $14,635.80 is now the new balance after simply 2 months. So if the strategies are already working, right, no need to fix what ain't broke, as they say. All we're doing is we're continuing to use the strategy. The next month, income going in, expenses and interest have to be added back on. The next month, the new balance, income is going in, expenses, interest, so on and so forth. The next month, income again going in, affecting this balance of $9,983. We got to add back the expenses and the interest. And we can see we are moving right along. So much so, so much so that in just a period of how many months did it take them to completely pay off the $16,910? Let's take a count on that. Following the same cycle, we got month number 1, month number 2, month number 3, 4, 5, 6, 7, 8, 9, 10, 11, and here we are entering the 12th month. If you see the balance of what is owed on the 12th month, on that $16,910 is $3,936.55. Well, we know that the income that he's going to be coming in throughout the course of that particular month is going to be way more than enough to cover for that remaining balance, which means that in 12 months, not 50 payments, which is over 4 years, right? But in 12 months, he's able to completely finish paying off their car loan and the credit card. And then he could take the exact same strategy and start applying it to the remainder of the mortgage that he will still have, which will put him in a much more favorable projection to completely be out of debt by the time he retires. And he can do this in over 10 years very easily. So I hope this helps. Please put down any questions or comments that you have below. I'll make sure to read them and get back with you on those questions and particular concerns you have. And please continue to share, subscribe, and like this channel. It helps the channel grow, and I definitely thank you for that. So until the next video, thanks for tuning in, and I will talk to you soon. God bless.